Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Carter's Inc. So let's get started. Now, what's Carter's? Carter's essentially makes clothes and apparel for babies, early childhood, kids. So they have the Carters, the Oshkosh, the Little Planet, and the Skip Hop brand. Some of these being acquisitions that they've made over time. For example, Oshkosh they acquired in 2005, Skip Hop they acquired in 2017. So now they're trying to become just a very recognizable brand for people who have just had babies and need clothes for them. They are mainly a retail store. They say that at least for retail, it provides the best experience with their brands and is the main source of customer acquisition at the end of the day, and that they also have 789 locations in 49 states and Puerto Rico. They also support e-commerce as well, so they are trying to make it work in tandem, sort of, where people look at the store, they can decide to buy with e-commerce later or do something with that. And they also have a low teens ROIC, so that's pretty impressive. They also have the e-commerce store where they're clearly changing the app and changing the website in order to have this house of brands, aka you can buy any of the brands that they own there. They also have a gifting experience now. So if you're a grandparent, maybe getting gifts for your grandchildren or your children who just had babies, you can sort of do that through the app. So that's good to know. And here they bring the point home by saying that they have a very strong social media following. So you see that the Carter's family of brands with Oshkosh and Skip Hop has more followers in general than comparable brands on TikTok, on Facebook, on Instagram. If TikTok is banned, at least that is the least of their followers there. They still have way more followers in Instagram and Facebook. That's millions compared to the hundreds of thousands on TikTok. But it would still be a hit if a lot of their marketing, a lot of their new marketing is being driven through TikTok, and then TikTok does get banned in the United States. They are a brand that mainly sells in the United States, but they do sell in Latin America, they do sell in the Middle East, they do sell in Canada. So that's important to know. Now, they also have partnerships here. So just driving the point home that they're big enough to have partnerships here that hopefully drive further revenue. So there you go. They can partner with Sesame Street, which is great. Who doesn't love Sesame Street? Now, let's get to business. Let's get to the numbers. Now, they're giving us an outlook for the next fiscal year. And they're saying that they're going to be either down to low single digits or up to low single digits, and US wholesale, both wholesale and retail. And then international is going to be comparable to 2023. Now, this is very interesting. They're also going to give us operating cash flow numbers and capex. So this is wonderful. We can work with it at least. And based on that, we can also look at the first quarter 2024 results. As you see, they've had a little bit of a tough year here, which is why they're saying that they may struggle a little bit in 2024, or like don't expect any super impressive numbers, of course, because net sales, for example, comparable with the first quarter of last year, are down 5%. Their royalty income is down 20%, although their gross profit is up, so their margins improved a tiny bit. Their operating income is down, but their net income is up, mainly because they're paying a little bit less of interest, which is great. This is what happens when you manage to reduce your debts. So it's just a little bit of a mixed bag in general. They had a pretty poor 2023 compared to 2022. This is something that you've seen in a lot of retail businesses where there was this euphoria in 2021 and in some portion of 2022, driven by the amount of money in the US economy. Then you saw inflation, then you saw less consumer spending, and all of a sudden they're struggling a little bit. So, hence, this explains this forecast, this fiscal year outlook over here, where they're going to say, okay, we may be down low single digits or up low single digits. So don't expect any huge surprises. Don't expect anything massive going on here. Okay? So that's important. Although they do say that their earnings per share are going to be up no matter what. And you know what? They were up 9% compared to the quarter before, and they may be up again. If their earnings are not up, then how do earnings per share go up? That's called buybacks. So you could expect some buybacks happening there, but that's the reason why I don't predict based on earnings per share. I use free cash flow, which I think is a much better measure. Now, let's look at the long term here. So from 2010 to 2023, you can clearly see that revenue has increased by a lot, right? So has net income, honestly, and free cash flow has increased too overall, although it has some choppiness here. In 2022, they barely had any free cash flow. In 2013, they had negative for a little bit. So you see some choppiness. However, the picture is everything is more or less improving. Free cash flow is very consistent at around more or less 10% of revenue, and with some volatility here and there, but you see some growth, and then they've been struggling in 22 and 23. That's fine. Overall, the picture is one of long-term growth, and if they can recover some of that growth, if they can weather off the storm, that would be great. However, something that gives me confidence here is looking at the margins. If you look at the gross margins, they started maybe in the 30%, and now they're consistently in this 45% range for gross margin. That means that producing new units, producing new items of clothing is actually less and less expensive for them every time. They get to keep more of that money. They have economies of scale going on. This is great. Operating margin, also pretty consistent here. In general, that 10 to 15% range. We love to see it. And then profit margin, that's actually pretty much stayed in this 5 to 10% range pretty consistently, which with the exception of 2020 for obvious reasons. So even though you do have a little bit of a sign that they're struggling with sales or revenue, and maybe also a little bit with free cash flow being choppy, you see that their margins are staying pretty consistent or even improving a little bit, which is great. That shows resilience and that shows that they're doing things right. If you see a company that's actually struggling in revenue and then their margins are also going down, that's when you should be like, okay, what is going on? They're clearly doing something wrong. Here, at least you see the sign of a little bit of resilience. So I want to do a quantitative model. And my assumptions for this model are going to be very simple. I'm going to say 10% of revenue is going to be turned to free cash flow. And I'm not going to grow this company from 2024 to 2027. I'm just going to say that that stuff stays flat, completely flat. Okay? Now, that gives me a value roughly of 293 million US dollars. This is basically saying that the level of revenue is going to stay the same from 2023, which if we saw their forecast is basically down low single digits, up low single digits. Okay, I'm just going to say that's a zero, right? Now, their perpetual growth rate that I'm going to give them is about 2%. I think that's in line with how much the global economy is going to grow in the long run. And then my required rate of return is 11%. Why 11%? That's 1% more per year than the market in general. I think over time that compounds to be quite a lot. So that's my overall required rate of return divided by the total number of shares out, and you get a fair value of $84.83. However, if you subtract the net debt, which they do have quite a lot, $789 million, then the fair value is $63.20. Now let's take a look at where the actual stock is at. Wow. So look at this graph first of all. It's crazy. This 5-year graph where you see it hit these 110 levels sometimes, and then you see it fall back down. And then you see it go back up and back down. So if you've held it for the last 5 years, you're probably not happy, but you see that there are buy and sell points. In 2020, it was totally a buy. And then you could have sold it here for a lot of profit. Here, you could have actually bought it and sold it in this 80s level for a profit. Now, it seems like it's also nearing that level again at $68.40 at a market cap of 2.5 billion, P ratio of 10, with a dividend yield of around 4.5%. It's looking decent. I'm not going to say it's the greatest stock I've ever seen, but when the 52-week low is $60, if it hits back that level and the fair value is 63.2, well, it could potentially be a buy. Or even if you say, listen, they've been reducing the debt, which is true. They had pretty much double the debt before. They've been reducing it. So say, listen, I don't care a lot about the 63 number. I think their actual value is closer to this $84.83. Then it would kind of be a buy here, unless you're seeing something like a recession coming, which obviously would make people probably have less children, probably try to skimp out a little bit on clothes. I mean, you're always going to get clothes for your child, probably before clothes for yourself. So they do have a little bit of protection there, but in general, there would be less spending, right? Now, All in all, I like Carter's a surprising amount, although not without caution. Strong margins make up for decreasing revenue and show operational resilience overall. The debt load is very high but lowering over time. So, being fairly valued in a no growth scenario shows that this company can outperform even with single digit growth, especially when it's paired with stock buybacks, debt payments, and a nice dividend. So, you have to see all the factors that would actually make the stock price go up. That being single digit growth um, or stock buybacks, debt payments, and dividend. So those are the factors that would actually give you money back. But it's still mainly a retail company, so you have to exercise caution. Retail is going to be some of the first affected by something like a recession. Retail is something that's affected by regional trends. It's affected by weather. For example, if it's very cold, very hot, a lot of people will want to show up there, and they have to show that their e-commerce can grow a lot before us being comfortable in the fact that retail can suffer a hit and we can still invest in it. So take a look at the big picture here. We're looking at Carter's, we're looking at a company that struggled a little bit at the beginning of these last 2 years, really. But at the end of the day, they're still very resilient. There are still factors that will actually help you make money back. So if you are comfortable with everything I've told you and with the overall big picture here, then it could be an investment for you. Now, thank you so much for watching. I really appreciate it. If you like content like this, don't forget to like and subscribe and comment down below if you want me to analyze any stocks you're taking a look at. Thank you very much and have a great rest of your day.